And now, as we unlock that savings along with that pent up demand, as well as the supply chains because of COVID, as well as geopolitical tensions, it just became the perfect double whammy, both on the demand and supply side. That's how financial markets are. In the short run, it's all about popularity and mobs and crowds going in one trend or the other. But in the long run, it tends to find its right place. But right now, the West cannot respond to the massive QE stimulus to the Putin invasion of Ukraine because they've already used all those bullets 1 or 2 years earlier for the pandemic. The big debate right now is the West and America in particular going to have a hard landing or a soft landing? Inflation right now seems to have peaked, definitely seems to have peaked in India as well. To say that the West is back to the 2% target and India is back to the 4% target, that's not happening this year. The first full clean year that we have, it will be interesting to see the GDP on that because everybody is driving blind.
Hello and welcome to another episode of the Bharat Varta podcast. I'm Roshan Karyappa. I have with us an old friend of Bharat Varta, Harsh Madhusudan. He first appeared on episode 3 way back when and has since appeared on multiple Bharat Varta podcasts. Harsh is an economist, investor, and author of 2 books. He's currently working on his third. His previous book was the best-selling New Idea of India, co-authored with another eminent Bharat Varta guest, Rajiv Mantri. On this episode of Bharat Varta, we'll talk to Harsh about some of the macro stuff happening on the economy front and how this impacts us. So without further ado, welcome Harsh. Thank you again for being on Bharat Varta.
Thank you, Roshan. Great to be back.
Yeah, it's awesome to have you. And of course, all of us know your views on Twitter as well. So it's good to, dig a little deeper on this podcast. To begin with, could you give us your take on, what's happening on the Indian economy front? We keep hearing of different things, right? Inflation, forex reserves, all of these things. What do you think is happening?
So I think the Indian economy and the Indian financial markets are two slightly different beasts right now because the latter is more connected to the global financial markets. The Indian real economy is also more connected to the global real economy, but not as day to day interlinked. So if you look at the Indian real economy on the ground, in terms of numbers, everything is very in unprecedented, uncharted territory. Because if you do YOY for the April to June quarter, then April to June in 2021 calendar year was, of course, the second wave. So that YOY base effect is all out of whack. You can do quarter on quarter, but then you'll have to analyze it. You'll have to remove the seasonalities, and then there also the war happened. So the fast-moving numbers are not necessarily giving a very good indication of what is upfront. I think most agencies and institutions have reduced the real GDP growth rate estimates for FY23. That is April 2022 to March 2023. But say about 7.5 percentage points. Although it must be added that the deflator, which is basically how much inflation there is, not exactly the CPI, is clearly and comfortably in double digits. So the nominal GDP growth rate in rupee terms in FY23 could end up around 20%, just like it was around FY22. So we'll end up having 2 years of around 20% nominal rupee GDP growth rates in India. So that's around a 45% increase after FY21, which was the first full year of the COVID. And that, in nominal terms is only slightly down, I think from 200 lakh crores to 197 lakh crores. So like around 5%, around 2% or something. So why does nominal matter? Of course, nobody is going to eat nominal rupees or nominal dosas, but in terms of debt sustainability, it matters. In terms of, because ultimately your country sovereign debt is debt to GDP, right? So if you are paying 7.5% interest rates on your debt, but your underlying GDP is growing at a denominator of 20%, then simple math says that your debt to GDP falls from the spike we saw during the first year of COVID. Similarly, a lot of other balance sheets are getting much stronger. The NPAs seem to be kind of finally being washed out of the system. But it's very important not to see the Indian economy in isolation. As I said, the financial markets are more intertwined, but the Indian economy is also, of course, cannot be said to be decoupled from the rest of the world. So, for example, in FY22, we saw a massive surge in exports because there was a massive kind of unlocked demand based on stimulus checks in the West, some problems with the China side of supply chain, although China did very well as well, and then of course other issues. We are now seeing the early days of when the Indian trade numbers are going in the other direction. It seems like that the restocking in America and other Western countries was probably overdone. So there was enough inventory built. So right now there is on the margin not that great demand that we saw in exports as we saw a few months ago. On the other hand, after the Russian invasion of Ukraine, the commodity prices have gone up dramatically, although in the few recent weeks and in some cases recent months, commodities have of course coming down again. So which leads to why in terms of goods, our trade deficit numbers were not so good last few months. For example, in June, it was, I think, an all-time high of 25-26 billion dollars. So that's the short to medium term answer to your question. I think long term, obviously, my prognostication, my bias, if I may say so. I'm very bullish because of two fundamental changes that happened in the global economy because of pandemic. I think geopolitically and hence geoeconomically, China and now Russia were seen as bad actors from the West's point of view. And you must remember that out of $100 trillion of market exchange rate GDP in the world, West is very dominant. And West, I mean here the US and Europe. You can even add Japan and South Korea, right? India is about slightly more than $3 trillion. So that kind of supply chain diversification, China plus one, what people in the industry call it, over and above the import substitution that we are anyway working with PLI and Atmanirbhar, etc. That's kind of gotten accelerated despite the short-term problems of chip supplies and other supply chain issues. So that's the good side. On the services side, the way we are talking on such softwares, what was earlier happening only for podcasts, etc., has now become a professional tool all over the world. And therefore, to that extent, services exports receives a fillip much more because you're not entirely location agnostic, but location becomes less important. And as I often say, if you can go from Boston to Austin, you can go from Boston to Bangalore, right? So, and we are seeing the early days and stages of cities like Bangalore, Pune, Hyderabad, Noida getting these global capability centers, right? Like these in-house R&D centers of multinationals, not just back offices, not just BPOs or KPOs, but one step ahead. So there is a cost arbitrage, but there is also a sheer lack of skills in terms of number of relevant graduates or engineers, etc. So on both goods and services, goods more because of geopolitical reasons, services because of technological reasons. Despite the massive tragedy that this pandemic was, and to some extent still is, in that slightly more medium to long term, I think it's like Sone Pe Suhaga. It's the icing on the cake for the India story, over and above the other factors that were anyway true pre-pandemic.
So, Harsh, your first answer has done exactly what I hoped for, which is open up multiple threads, and we'll kind of deep dive on each one of those, right? To begin with, on the episode we did on Modinomics, we discussed how the base effect is totally out of whack, right? I mean, considering the last couple of years have been so exceptional with COVID. So, as an economist, as an investor, like, what is the reference point that you consider in terms of measuring, let's say, growth or tracking progress and things to that effect?
So I think once again, this is where we are completely in uncharted territory. So different economists have argued for different metrics. Some have said, Y and Y still make some sense. Some said, no, look at Q and QOQ, quarter on quarter. For inflation numbers, increasingly, we are even looking at MOM, month on month. One way to think about this is, okay, we were at 100 pre-COVID, say in real terms, and let's say our trend has been, say, 7% GDP growth rate, right? Although we were already kind of slowing in before COVID for a couple of years. So one way to do that is to extrapolate, FY20 was 100, because only the last 15 days of FY20 was actually impacted by COVID. So let's assume FY20 to be uncontaminated, so to speak. Let's think of FY23, which is the year that will end next March, the fiscal or financial year that will end next March, and just do a CAGR, a compounded annual growth rate of say 7%. I don't know how much that comes to, maybe 23, 24%. So you're saying in real terms, if we were at 100, should we be at 123, 24 is the best case benchmark. It's the best case because obviously it assumes no short-term damage. It also assumes that the already slowing trend pre-COVID also got corrected, right? So that's one way to understand. And it's not very useful, but it is more useful for slightly longer periods, 5 years, 7 years. And the reason why I say it's slightly more useful for slightly longer periods is because the short-term damage of COVID then kind of gets offset by the slightly longer term benefits. I mean, it sounds a bit morbid to even use the term benefits for COVID, but because of this phenomenon that we all kind of lived through, which I discussed in the first question you had asked, it becomes to balance out a bit more, right? I mean, these benefits of services and goods exports becoming more competitive in India. Because of the emergency, the Indian monetary policy finally becoming more sane and rational, which it was not earlier. Pre-COVID, Mr. Das had started to rationalize it a bit, but it seems that Mr. Patel had, the earlier RBI governor, Urjit Patel, had probably in overcompensation for demonetization to get the quote-unquote credibility of the RBI, to make it seem more credible in his own circles. I mean, I'm not necessarily being very charitable here, led to higher than required monetary tightening. A lot of these things got reversed in the average avalanche that faced all of us, right? So right now, well, minus 7% in FY21, but let's say plus 9% in FY22, or in FY23 we are plus 7%. So we clearly know nowhere close to 7, and 7, right? Because the first 2 years almost got cancelled out. So right now the question is, what is the underlying strength of the economy, right? One way to think of the economy, what I had mentioned in the last podcast, is one way is path dependent. So this is what we are doing here, right? We're just taking a given number, and then we are doing a CAGR on top of it. The other way is to think in terms of factors of production. So for example, there is enough labor, X number of labor, Y number of kind of human skill sets that it has, and similarly capital and real estate and industrial goods. So while some of that kind of human capital and physical capital and financial capital also got hurt, it wasn't like completely unhurt, the underlying potentiality of that. But it did not get hurt as much as the GDP numbers got hurt. I mean, to take an extreme case, if they were just shut down for 2 months, that potential was there, but they were just not used for 2 months. And humans are very, very entrepreneurial, right? I mean, they will use those 2 months for maintenance capex. They will try to do other things. They'll try to be as efficient as humanly possible in that situation. So even if we kind of knock it down a bit, basically reality in the next 2-3 years should be a combination of this path dependence and this kind of aggregation of potentialities of human and physical capital, which is why in the next couple of years, because remember, FY23 is the first real year. So the current fiscal year is the first real year where we don't have a serious COVID wave. Because last year, not only did we have the crazy second wave in early FY22, we also had a somewhat concerning Omicron wave towards the end of FY22. So right now, while cases and deaths are continuing at about 40 deaths per day, and every death is a tragedy, but right now there's no serious COVID wave. So this is the first full year. Although again, in this year now we have the impact of the Russian invasion of Ukraine.
Yeah.
So at a point, it starts sounding like excuses as well. So even if we kind of ignore the invasion for a second, this is going to be the first full year, and it will be interesting. And I've been saying that the first full clean year that we have, it will be interesting to see the GDP on that, because everybody is driving blind.
Yeah.
And as they say, like, predicting is hard, especially about the future, right? So it will be interesting to see how the numbers play out.
Yeah, no, it's certainly very fascinating. Another aspect that you brought out is the divergence between the markets and the economy, right? Again, in 2021, we saw this unbridled optimism in the markets. We saw the bull run of bull runs, and then that has since seen a correction. How does a layperson look at the markets and look at the economy and then sort of make sense of both of them together in cohesion?
See, once again, I mean, very round numbers, very rough numbers. The global GDP is about 100 trillion, give or take. The global market cap is about 100 trillion, give or take. In India, in both cases, is about 3.5% of it. And the Indian equity markets, unlike the Indian bond markets, are completely open. So what happens is, whenever there is a massive inflow of capital, we get impacted positively. Whenever there is a massive exit of capital, we get impacted massively on the other side. For example, since last October, when FIIs have been leaving, till maybe as recently as last week, and we'll see if that was a false dawn or not. With the caveat that there is now enough domestic institutional capital, either through mutual funds or
SIPs,
or directly sometimes through our version of Robinhood traders, or Zero Dha traders, whatever you want to call them, who are giving some support to the Indian equity markets, which would no doubt have reacted much more severely over the last few months had this capital not been there. So the simple answer is, the financial markets are just more volatile because the equity markets, especially in India, because the coming in and going out of capital is just much more open, and therefore you see pronounced up moves and pronounced down moves there. And you were right, last year the actual real economy was very difficult for a lot of people. This year the real economy seems to be better, but the financial economy, the financial market seems to be more pessimistic. So as Warren Buffett said, right? I mean, we are a weighing machine in the long run and a voting machine in the short run. That's how financial markets are. In the short run, it's all about popularity and mobs and crowds going in one trend or the other. But in the long run, it tends to find its right place.
So another big and scary term that's doing the rounds lately is inflation. And here it is a double whammy of sorts, right? I mean, last couple of years, we hear that, 40% or 50% of all the dollar notes were printed. At the same time, you had all these demand constraints, right? Whether it was supply chain shortages on the semiconductor side, or oil and so on and so forth. What is your take on inflation and how it really impacts a layperson?
See, again, to understand inflation, we have to go back 40 years in the West. So the 70s were a terrible decade for inflation. There were the oil shocks, there were the Arab-Israeli wars, there was the formation of OPEC. The cartelization of oil supply, and finally, and also, of course, the dollar getting off gold, by Nixon in 1971. So for the first time, we had genuinely free floating currencies backed nothing but by the sovereign fiat. It was very new for the markets. We had the introduction of derivatives, global currency and commodity derivatives. By the end of the 70s, Paul Volcker, who was the chairman of the Federal Reserve, and the early 80s, he really started. He was influenced by this theory called monetarism, which said, okay, if you have so much more money supply in the market, but the number of goods is not changing that rapidly, you will eventually get inflation, right? I mean, and there are many nuances to that. Let's not get into the this capital M monetarism versus small m monetarism, etc. Let's just stick to the broad topic. And he basically almost engineered a small recession by dramatically increasing interest rates. So I think inflation kind of reached till 15%, but interest rates went almost up to 20% in the US. And then somehow all this happened in the first term of Ronald Reagan. But somehow both Reagan and actually Margaret Thatcher survived their first terms in the early 80s. And then a very broad kind of expansion happened till the global financial crisis in the West. I mean, of course, the Asian financial crisis happened in 1997 in Asia. But what happened was the signaling to the markets was that we, as the Western central banks, we are ready to take pain in our real economies if it means curtailing down on inflation. Now, that is one explanation. There are other explanations as well. People say it was just demographics. 70s was when the baby boomers became adults, and you suddenly had a massive increase in demand. And as they grew older, and there was more savings and less investments, and inflation went down because of less consumption also on the margin, and the real interest rate of capital kept on falling, etc., etc. So there are multiple explanations. One of them is the central bank one of them is structural demographic one. But from the 80s till the financial crisis, inflation was broadly coming down. What happened after the financial crisis was we had a very big QE and cutting of interest rates, but not as big QE as we had during the COVID time. So that's part of the story. We'll come to it. We didn't have as big a fiscal stimulus that time. I remember this is all the Tea Party movement. Obama had just become president, and any single dollar more being spent was going to lead to Armageddon, etc. And what the Western policymakers thought about that was, when this crisis hit, when they were thinking in the 2015, 2016 about what happened 7-8 years ago, they started to come to the conclusion that we probably underreacted. Maybe more on the fiscal side, but as a general aggregate demand kind of boost. And the reason was core inflation was 2% or less. Inflation just did not come after the global financial crisis happened in 2007, 8, 9. And people were like, okay, we did QE, we did all this stuff, and inflation was nowhere to be seen. Whereas China went one school of thought, did this kind of quasi MMT, like modern monetary theory. It took on so much debt, built infrastructure, did so well in high-speed rail and roads, and became the world leader in large parts of the electric vehicle kind of supply chain, from lithium-ion batteries to just e-vehicles, etc. So the idea, and then there were, of course, partisan and philosophical ideological debates. The left in the West was more likely to push for this. So when this opportunity happened, this tragedy presented this kind of political economic opportunity. This time, basically, despite warnings from moderate Democrats like Larry Summers, this time, and after Trump got defeated, they had the houses in the US as well, House and Senate. They just went all out initially. There was this massive global tragedy, once in a century pandemic. And this time, along with much more monetary, they did even much, much more fiscal response. People are literally getting stimulus checks. And you had some reasonable explanation for that. At the time, maybe the quantum could be negotiated with, that you listen, you're asking people to stay at home, what happens? Basically, they kind of engineered for the worst. Actually, a lot of that did not get spent because they could not go out and spend much. And the essentials don't take up that much. So a lot of savings got added. And now as we unlocked that savings, along with that pent-up demand, as well as the supply chains because of COVID, as well as geopolitical tensions, it just became the perfect double whammy, both on the demand and supply side. And if that was not enough, the Russian invasion of Ukraine was the final kind of straw that broke the camel's back. And it's not a coincidence. Putin and his team must have wargamed it, saying that precisely because the West is vulnerable right now in terms of inflation and energy. Because imagine if inflation was 0, 1, or 2%, and if only he had the energy cards, then the West could spend a lot of money on the energy aspects. But right now, the West cannot respond to the massive QE stimulus to the Putin invasion of Ukraine because they've already used all those bullets 1 or 2 years earlier for the pandemic. So it's not a coincidence. So that was the final thing that came and really made a mess of everything. In the US, it seems seems that core inflation is peak. Core personal consumption expenditures has actually been falling for 3-4 months. We'll see what the latest number comes out in a week or so. Europe is slightly more worrying. I would say much more worrying actually, because there is active blackmail happening on the gas and energy exports from Russia. They just had a weaker economy to begin with, and there's much less kind of. I mean, Europe is not one country. The European Union or the Euro area is not one country. They have a monetary union. They don't have a fiscal union. At the same time, because there's much more worrying there, they actually cannot raise interest rates that much, which is why the euro has been weakening against the dollar, because in the short term, currencies respond to interest rates. And the yen has been weakening even more because Eastern Asia seemed to have had less inflation so far. See, the supply constraints are global, right? Energy problems are global, but they did not have such massive stimuli the way especially Western governments did. So Japan so far, I mean, the numbers in Japan are also a bit problematic because they suppress inflation through targeting in a very smart manner the causes of inflation. They'll give you subsidies for energy or food or etc. But nonetheless, it is lower in East Asia. And India is somewhere in the middle. But people who really got caught out were the smaller emerging economies, because they just did not have the scale and the resilience. And they were like one or two export items or services or tourism dependent economies, for example, Sri Lanka, and you make one or two mistakes, like take too much Chinese jet or organic agriculture without fertilizers, etc. And you just, the what cannot be mentioned hits the fan. And that's what happened. So inflation right now seems to have peaked, definitely seems to have peaked in India as well. Again, there are the base effects. But to say that the West is back to the 2% target and India is back to the 4% target, that's not happening this year. That may not happen next calendar year as well, at least in the first half. It could happen in the next fiscal year or maybe the second half of the next calendar year. Although the flash PMI, the kind of growth early reading, real-time reading for services in the US yesterday was 47.5, which is a big shock. Below 50 is supposed to be recessionary. So if there is, so right now the big debate is not about inflation being peaked or not. I think that debate is now a few months old. The big debate right now is the Western America in particular going to have a hard landing or a soft land, right? So there is a slowdown no matter what. If there is a slowdown without a recession, even if it's a technical recession, but there's not a lot of widespread economic misery, let's use recession in a more colloquial term, that's a soft landing. If there is a proper hard landing, that means it's a problematic and painful deep recession, not a narrow, shallow one at best. So that is the big debate right now. What we saw in the markets last 2-3 weeks was people were thinking, well, inflation is peaked. It is problematic for a few more months for sure, but maybe soft landing is likely. Yesterday night, the American markets were down by 2% for the NASDAQ, for example, because of this reading, which people suddenly worried much more about the recession. So India is in a unique spot because whenever the global markets boom a lot, we have a natural hedge. We don't boom that much because commodity prices increase that much. But when there is a global slowdown, we don't get hurt that much because commodity prices fall that much, right? So because whereas commodity exporting countries or net commodity exporting countries are much more volatile. They are high beta assets. So India has a low beta asset in that sense, because when things get well, we have some bad news as well. But when things go bad, we have some good news as well. So I'm not very concerned about India, but to answer your question about inflation, it really was a soup of a lot of terrible things that could have gone wrong, which went wrong together.
So 21-22, we also saw record amount of exports, right? And partly I suppose because of industrial policy, partly because of geopolitics. We're seeing now that the rupee is like at an all-time low against the dollar as well, right? With forex reserves declining and stuff. We also saw maybe a week or 10 days back, RBI allowing trade in rupee as well, right? Again, which is a significant move from a signaling perspective, even if not, having that much of an economic impact in the short run. What do you see happening on the exports front?
See, on the export front, as I mentioned, FY22 was a boom year. FY23 is slightly less so because, I'm talking in relative terms, slightly less so because the great restocking in the West is kind of over, right? In fact, if anything, they have, in some cases, excess inventories. So when the great boom happened, the rising tide took over all boats, right? At the same time, we should not underplay India's achievements because it was not just a massive increase in percentage terms, but we also won global market share. So the real test of an export boom, the real proof of the pudding in this case is in the eating, by which I mean, have you gained market share? So we did gain some market share, but the market share gain was not as impressive as the absolute increase in exports.
Yeah.
So clearly some benefit of the industrial policy, trade policy, infrastructure, political stability, just hard work by our engineers, entrepreneurs and businesses in general, that definitely led to some fruits and will lead to more fruits. But there was also kind of a short-term cyclical element to that, which we should not completely overlook. So I think exports, as I said, are going to do very well because the China plus one diversification is not a 1 or 2 year process. It's a 10-year process. It probably won't even happen in 5 years, right? Because you can't move too fast. There are too many vulnerabilities. There's too many sunk costs because what happens when you put a factory on an ongoing basis. That's what microeconomics tells you. You're not looking at an overall cost recovering. You're just looking at operating cost recovering because technically the factory there is already sunk cost, right? And so therefore it's much more that is classic path dependence. So Tesla cannot leave China very easily. It may eventually because of geopolitical tensions, but Tesla is already there. And therefore, it does not make much sense for Tesla to open a factory in India right now. India is playing hardball as it should, but from Tesla's point of view also, it doesn't make much sense to have a massive factory in India and then export globally from there and also serve the Indian market, which anyway is much smaller than the Chinese market when it comes to luxury or quasi-luxury cars. So long story short, we are also kind of importing much more chemicals and pharma, a lot of intermediate products, APIs, input chemicals, a lot of stuff from China. And it's going to be very, very hard work to sector by sector do import substitution. It won't be conceptually neat, right? So if you have a PLI for toys and you're a free market 101 guy, you're like, what are we doing? And honestly, with a less honest government or less competent government or worse both, that's classic recipe for cronyism. So we should always have our skeptical hat on, and these policies should be time bound, but some policies are required. What is needed to complement that on exports or trade more generally is to trade much more with geopolitically friendly countries. In fact, the US Treasury Secretary recently coined a new term called friendshoring. So, we've heard of onshoring, offshoring, reshoring, nearshoring, right? Onshoring it's in America. Offshoring is in China, nearshoring is in Mexico, reshoring is coming back to America from China, and friendshoring is if you are geopolitical friends or allies, right? Because America, despite automation, despite robots, is not going to end up manufacturing everything. They might see some manufacturing renaissance, they might see some jobs also back, but probably not too many. Countries like India become very important, and we're already seeing on the margin, for example, marquee names like Apple shifting production to India, and all kind of problems happened. There were mysterious fires and incidents and labor problems in some of their kind of subcontractors. And one does not need to be a genius to understand who benefits from that, right? So there are those issues. Now on the currency side, I obviously wrote on Twitter some months back that it's less than likely. I said it's less than even probability that we hit 80. We actually did hit 80 a few months later. Although it's interesting that we kind of, even now we're in the high 79s. What I mean by that, that's obviously meant to be just a symbolic representation of my view. What I mean by that is fundamentally the rupee is undervalued. Fundamentally the dollar is overvalued. What I mean by that is dollar goes in cycles. 2002 to 2011 was a weak dollar cycle. And while there's a short boost in the middle because of the global financial crisis, 2011 to 2020 would have been the strong dollar cycle. Now, because of the pandemic and the war, you kind of extended that by another 2 years. And these are very cyclical things. Once they turn around, they turn around. What happens is in a massive global risk-off environment, everybody goes to the dollar. That's just the benefit of having the world's reserve currency. You can print, as you were saying, not literally print, it's mostly computer entries, 30-40% of your existing number of dollars in 2 or 3 years, but everybody will still go to your assets because you're the largest, deepest market. You're liquid. Most people are psychologically dollar denominated. Most institutions are there. So that's just how reserve currency works. There is some interesting debate whether it's all network externalities that will only one reserve currency or you can have 2 or 3 reserve currencies. But really right now, nobody's as dominant as America. China is getting close in terms of economic output, but it does not have an open capital account. India is much smaller. India does not have an open capital account. It could in the coming years because it is not geopolitically agnostic, rather antagonistic to the West, right? So it'll be interesting to see how that plays out. But right now, the dollar is the world's only real reserve hard currency. And despite all the printing, money goes there in risk-off times. And the final point you mentioned about the long-term beneficial, short-term symbolic measures just settling in rupees, opening up a bit more of a sovereign debt markets. That's excellent news. I think what is still disappointing is for the last 2-3 years, we've been discussing entering these global bond indices. And that would be, by the way, rupee debt. So the Forex hedge risk would be in the name of the investor, not in our name. We've not done that. That would have led to a lot of sticky capital. The reason why those capital is sticky is because if you enter a global index and you have ETFs based on that, your country has certain weightage. Let's say India gets 10% weightage, 5% weightage. The weightage might go up or down in a given year, but it doesn't go up or down dramatically. And all the passive funds, right, which are just pure beta funds, not alpha funds, which are just replicate this index, or maybe they might be smart beta funds, they might have slightly different weightages, but broadly that weightage, that money becomes sticky money. So we are at a unique situation where we are openly selling our equity, but we are not selling our debt that openly, saying that debt is borrowing, but somehow equity is fine. So we give the upside, but it's not borrowing. And I understand when we were a much smaller economy, that was much more risky. I think we were thinking of opening the capital account, and it's a process. It's not a one-day event. 97, the first Tarapur Committee report happened. The Asian financial crisis happened. 2007, the next Tarapur Committee report was being made for opening up the capital account. The global financial crisis happened. Now, 2017-20, I mean, there's nothing after the global, but we had the pandemic. At this point, I think it's a generational issue. I think the older policymakers are just understandably scared. But I think Indian economy is much bigger and resilient than our mental models think about. And sooner or later, we will open up the capital account. Only two broad things are left, right? Allowing foreign money into our bonds and then allowing our money to go out. So, for example, a few months ago, SEBI kind of put a cap or did not raise the cap for mutual funds in India investing abroad, right? Okay. So in sequential terms, I understand that. So not very passionate about that necessarily on day one, but why not allow sticky money to come to our bonds? And if you don't want that, at least have a more rational monetary policy in India, right? We are still in the early stages of building that monetary policy institutional architecture. The MPC is only a few years old. It was renewed only a couple of years ago. The entire process around it, 6 members, 3 outside, 3 inside, it's all very new right now. There is no discussion on what the real neutral rate should be and how it should vary with time, etc. And so it's all very new. I don't want to say we should do everything yesterday, but to answer your question, it seems that the rupee is probably peaked out. Maybe if we get one or two worse than expected US inflation prints and we see some more dollar index strength, maybe there is some more weakness left. But fundamentally, we are due for a snapback, and that will be interesting because that is often along with global growth and therefore Indian exports increasing again, as well as foreign capital coming in. The hierarchy broadly is correct, right? FDI. So FDI is doing very well in India. FDI is the stickiest money. Once you invest in a factory on the ground, you just can't take the factory via the computer. Next, after that, we have FII, which is equity and debt. So we are doing well. I think the rupee will also do well. I think exports will also do well, both on goods and services. But in the next few months, it's going to be difficult because there was excess inventory build up in the West, and we really don't have. If you look at commodity prices, steel prices, if you look at what's happening in China, the slowdown with their somewhat insane COVID lockdown policies. In the very short run, I don't think we should expect bumper numbers like we expected last year.
The last couple of years has also been a lesson in geopolitics for all of us. And it's really tough to divorce any of the macro stuff that's happening in our geopolitical situation from the economy or anything else. We've seen, for example, FTAs, right? We've seen these post-COVID alliances being formed, right? Quad and so on and so forth. What do you make of that front? How have we done on that in the last year or couple of years? Minister Jaishankar often says, we have to put our values and interests first, and we've seen India being really robust on these fronts, right? So yeah, your thoughts on this?
See, economics is never economics; it's always political economy. We forgot that at our own peril. In fact, I'm quite proud that the book I wrote, you mentioned my second book, A New Idea of India with Rajiv, and the book was kind of finished in the first 1 or 2 months of the pandemic. It came out, I think, in September of 2020, and the 4th chapter of the 5 chapters in the book, which is on economics, the only place where we kind of dissent from so-called economic orthodoxy was on trade, and we kind of laid down exactly what we are now discussing, what became really, really obvious in the next 2 years, which is that no large countries ever become rich without some kind of industrial trade policy. It's just a fact. I'm not saying nobody can. I'm just saying nobody has. Whether it was the United States, which had 40% weighted average tariffs throughout the 19th century. Germany had the Zollverein. It had the Proto-European Union Customs Union. Japan, massive industrial trade policy. South Korea. England, even before the United States, it had all these kind of Calico Acts, wool tariffs, etc. Most famously suppressing Indian manufacturing to build up their own. Nowhere has it happened. And of course, China. It was all asymmetrical. It kind of very smartly played the emerging market card. It entered WTO in 2001, but really never allowed others to enter its market to the same extent. It kind of manipulated its currency early on, not so much right now. All that happened. And the reason is, you can read Danny Roderick, who's less of an orthodox economist, and I disagree with him in many parts, but he basically is right that, your starting point, you do not have good institutional structures in terms of manufacturing and services, exports and productivity. A cheaper currency and some kind of industrial trade policy can work. He's now less optimistic about other economies catching up because of automation. That's a separate issue. But I think India did the absolute right thing. To be fair to Narendra Modi, the Prime Minister, he and his finance ministers tried in the first term to do it more in the more orthodox manner. But I think towards the second half of the first term itself, despite objective objections by people like Dr. Arvind Panagaria, who was very much at the helm of the Niti Aayog, and somebody I look up to and a very good friend, but I disagree with him on this particular point. The Regional Comprehensive Economic Program, we just did not want to enter a China-dominated FTA right now because we were not quite there ready. So I think that's basically what happened. Now, however, that does not mean trade is bad. It just means that you have to trade with geopolitical friends and allies, exactly what the US Treasury Secretary called friend shoring.
Friend shoring.
So we have now an FTA with the UAE. We have a quasi FTA with Australia to be kind of firmed up soon. We are in talks with the UK with Boris Johnson, maybe soon with either Liz Truss or Rishi Sunak. Let's see. EU, it has been brought back from the dead, the negotiations. And finally, the big gorilla would be the US. And the thing is, they're also understanding that you cannot simply divorce economics and politics, or you cannot rely too much on economics to neutralize politics either. So, for example, what was the grand strategy of Germany? The grand strategy of Germany was, if you want to export Mercedes to China, just shut up about the geopolitical issues. And if you want to import crude from Russia or gas, shut about their geopolitical issues. And both failed, right? So because it works, if you are the larger economy and the other economy is much, much smaller, then you might then that strategy might actually work. It is, for example, rational right now for India. And again, a thing which I think a lot of people do not appreciate, to get a much smaller economy like Pakistan into its trading net without conceding anything on anything, if at all being more aggressive in terms of our claim to POK. But once the Pakistani economy is integrated in the Indian economy, it becomes much more difficult for them to do adventurism. Just like it is very difficult for Bangladesh to do adventurism right now. It works when you are the larger economy. For right now to take on China in a completely open trading net, when it's 5 times its size, right now slightly more at market exchange rates, would have been completely suicidal. So I think maybe by method of elimination, maybe a couple of years late, this government has done the absolute right things by trying to minimize the trade with China, which will take a long time because we are very much dependent and enmeshed in those trading networks, and looking more either to the Middle East or the West or Southeast Asia. And I think that's what we are doing right now. Again, very early days.
Another favorite question is how all of this impacts the $5 trillion by 2025 goal, right? The chief economic advisor, Mr. Anantha Nageshwaran has said that it might slip to 26, 27, and he sees that we could probably be 10 trillion by 2033 or 34.
I love these debates and discussions as much as the other person. In fact, I have written articles about this and spoken extensively about this. But let's first understand that we are basically discussing something which has to be broken down into two parts. India's actual GDP in rupee terms, and then what the dollar rupee does, right? Because you could do very well in the rupee terms, your nominal GDP, but if the dollar rupee is out of whack, you don't reach 5 trillion. On the other hand, you might do slightly less than optimal on rupee terms, but the dollar rupee turns around rapidly, you'll reach 5 trillion. And to be fair, that 5 trillion, I'm on record to say that not just 2025, maybe we might even hit by FY25, which is March 2025 actually instead of December. It may still happen because it just depends on the dollar. So of course, that dollar pre-COVID, the trajectory of the purchasing power of the dollar is no longer as what it is today, because instead of seeing 2% inflation in the intermediate years, we have seen 2 years of almost double-digit inflation. Having said that, that should be kind of baked into the cake for these kind of adverse events and national emergencies, because the only thing left for the sovereign is to dilute the value of the currency. So if you play that all together, I still think we can hit 5 trillion by 2025, because as I said, we had nominal GDP growth rate. It looks like 20% in rupee terms for 2 years. Assume it we have 197 lakh crores in nominal terms at end of FY21. You add 44% to that. So that's almost 280 lakh crore odd by next March on a trailing 12-month basis. And then if the rupee suddenly turns around, which, as I said, it's a cycle. It's not just the rupee, it's the dollar itself. The rupee's actually been doing very well compared to even euro and yen, forget other emerging economies, right? We could easily hit 4 trillion by somewhere in the calendar year of 2023, by end of 2023. And we would almost certainly overtake Germany. And unless there is a massive snapback in the value of the yen, which is possible, certainly possible, because right now the divergence of interest rates is very kind of unusual. We might even overtake Japan before 2025 and become the world's third largest economy. So fundamentally, again, of course, it's something to celebrate, no doubt. Not something to celebrate too much, because of course, in per capita terms, we're far behind, right? And just the population is much larger. Fundamentally, the real effective exchange rate, the inflation adjusted interest rate of India is needs to be much higher based on our growth. Actually, see, in the last 1 year, almost the U.S. inflation has almost constantly been higher than India's. In that situation, in equilibrium conditions, and economics equilibrium is almost rarely there. It's not there most of the time. Equilibrium conditions, the Indian rupee should actually appreciate because it saw lower inflation. The currency with higher inflation actually depreciates. But because it's the US, so whenever there is global chaos, maybe in the US, maybe because of the US, you still go run to the US because that's where the most liquid deep market of safe assets is, US treasuries. So it's different for other country pairs, but it's very different for a US ex country pair. So US was running higher inflation than India the last year or so, but actually the dollar has appreciated because it's a risk off sentiment. Now, of course, ideally you should not compare CPI, you should compare deflators, and on deflators, the difference between the US and India may not be that much, but still, the fact that we are even discussing US inflation being higher than India is unheard of.
Yeah.
So which is why I think we should. It's very kind of silly to extrapolate based linearly on the last 2 or 3 years. So FY25, March 2025 is still almost 3 years away. I think the real economy will do well, and I think the rupee will also do well. And therefore, I would not write off FY25 yet. Of course, Dr. Anand Nageshwaran, who's a friend of mine, a mentor, and with whom I wrote my first book, along with Dr. T.V. Somanathan, he is saying the right things as somebody in a position of responsibility. I think after so much damage to the health and economies globally and not just in India, it's probably sensible to play down expectations. But if we are discussing as analysts, I would still not write that off.
So he's just doing the right thing by under promising and hoping to over deliver on that.
Yeah. So the point is, see, it's okay for me to say FY25 is still $5 trillion possible. Yeah. I'm kind of laying out my thesis. Some people will say it's bold. Some people will say it's completely foolish. That's fine. But if you're the chief economic advisor of, the world's largest democracy in the finance ministry, you might have a particular view. You cannot say this linear extrapolation will stop in the next 1 or 2 years and will turn around.
Yeah.
That thing should be left to hedge fund managers. So I don't think he is doing the right thing by playing down expectations.
Right.
Because after all, this massive damage that the pandemic did gives all policymakers reasonable leeway to reset expectations. Because if you're saying this because of a pandemic and a war, it is kind of force majeure, right? You're not saying it is because of my incompetence or my government's incompetence this is not happening. There was a real once in a century traumatic event that happened. So it's sensible to use that to reset expectations. But that's in the public communications hat. As an analyst who's not affiliated with the government, I can still have a different view.
Arguably, I think the last couple of years also has been perhaps the biggest challenge for the finance ministry, the RBI, and so on, right? Of course, there have been similar challenges, earlier in India's history, I would say. But, it has been a heck of a challenge, no less. If you were to kind of assign a report card on, to the finance ministry or the RBI, what would that look like? What did they get right? What did they get wrong? Right. And on that note, what are some policy interventions that you hope for in the next, 2 to 5 years?
I would give both of them an A-. And I would say that many people, including for a few weeks me, we were wrong. Initially, I remember us being hysterical in the sense of oh my God, we've done this massive lockdown. And what happens? Because it was completely uncharted. So there is an element of their wisdom, competence, small c conservatism, and just quite frankly, luck and the blessing of the gods as well, because it was completely uncharted territory. The fact is, we built up our reserves. We did not immediately spend our fiscal firepower. And I think somebody like Sanjeev Sanyal, who was the principal economic advisor, he explained it very well. He said, what's the point of giving massive stimuli when you're telling people to simultaneously be in their houses and then giving them money, right? So let's do it on a more kind of graded, data dependent, in kind as well as in cash combination. And we basically built up our strength and did not spend it all in one go. And that turned out to be so incredibly wise. For example, our forex reserves, and this is just in the cash segment, went from I think $640 billion to the latest number is 575. So that's around $65 billion we've spent. We've been able to spend that because we first built up those buffers by almost $200 billion. And there is a separate kind of derivatives book, forwards book, which the RBI had, I think it was $70 billion earlier, it's maybe $50 billion now. So actual reserves might be slightly higher than what these numbers say, but even they have fallen, right? Similarly, in the fiscal side, the political optics was we gave this, we gave that, but a lot of that was not a lot of actual fiscal expenditure. A lot of them were guarantees or loans being underwritten, or some waivers or some things being postponed to the next fiscal, etc. So that in the entire package was not necessarily checks in the account of a lot of people. There was PM Kisan, there were other very targeted subsidies. Again, the Jam Trinity kind of infrastructure helped a lot in that. These digital public goods do that without corruption. As just imagine without all the technology living through the pandemic, impossible, right?
Yeah.
Across the socioeconomic divides. Of course, people who are more privileged got it easier, but even otherwise, imagine giving somebody money without them having a bank account or some kind of phone. So I think they did an excellent job by not giving into the frenzy initially, being data dependent, being small c conservative, at the same time not being completely conservative and not running a fiscal deficit as they should have. They did run a big fiscal deficit, just not massive double digit, consolidated terms maybe double digit, but not at the union level. So as a percentage of GDP. So I think really excellent work by the finance ministry, a lot of small tweaks and reforms. Of course, the larger government itself, not just the finance ministry. Some of them had to be rolled back because of political reasons like the farm laws. Others stuck. This whole Atmanirbhar thing being unveiled by the finance minister, prime minister, commerce minister, much needed, as we discussed earlier. On the RBI side, as I said, Mr. Das has turned out to be much more pragmatic than his predecessors. And so it's not about questioning the intention of Mr. Urjit Patel or Raghuram Rajan, especially Mr. Patel. I'm sure he meant well, people like him and Viral Acharya, but they were just wrong. I think they just overcorrected for the past inflation they were seeing, and they were not being data dependent. Urjit Patel made a mistake, but Shantikanta Das has come. He has said growth is important. Of course, the primary mandate is inflation for the MPC, the Monetary Policy Committee, but we can't be completely oblivious to growth. It has to keep that in mind. They have, if you have 2 quarters of above 6% CPI readings on the headline, you have to send a written explanation to the Parliament, which I think they will do. These are clearly, if at all there is anything called unprecedented circumstances, this probably qualifies for that. So they were not, jo Hindi mein bolte lakir ka fakir, they were not going only by the rule book. They used their common sense, and thank the gods for that, because it seems like without the RBI being quote unquote dovish, things would have been much worse. What I obviously want them to do, both the government and the RBI, is to slowly, gradually open up our bond markets. I think we are being, as I said, too overly protective. We need to open the capital account because we also need to become the financial center of the world, one of the financial centers of the world. I mean, Indian financial centers are basically London, Dubai, and Singapore, to some extent Hong Kong. Mumbai is not a global facing financial center, very much for India. And some work is now happening, obviously, in the gift city. But very early days, you have to internationalize the rupee. And you have to understand that we are becoming a larger and larger part of the global economy. And despite being, quote unquote, strategically autonomous, as we saw in terms of buying crude from Russia, which of course the Europeans are also, we are still broadly aligned with the West. We're not allies with the West, formal treaty allies, but we are aligned with the West. It's fine to assume the worst in other people, trust but verify. But if you are always assuming the worst case situation, you let go a lot of alpha as well. And I believe that it's not just about money coming in, lowering the cost of capital. It's also about Indian entrepreneurs, as per their skill sets, buying the best possible assets globally, not just in terms of corporate purchases, but also financial purchases as an optionality for future corporate purchase. Why not? An analyst in Wall Street is probably less than $200,000, $300,000 doesn't make sense with the cost of living in New York. But somebody in Gujarat could analyze entire sectors and just invest all over the world. They still can. There is LRS of $250,000. I don't want to overplay the situation. But imagine the kind of ambition and talent and raw hunger we have in India. I think it just comes down to, as I said, confidence and a generational attitude issue. And it will happen sooner or later. I really think that there was some technical tax reason they quoted saying that, okay, about capital gains, if foreigners buy Indian bonds, how can they be exempt from capital gains effectively while domestic people are not? And that is a good point. Well, you can just remove capital gains on bonds, government bonds. As it is, the government is giving the interest rate, and then the government is getting a tax on that. It's just one hand give, other hand take. Just remove the capital gains tax. I mean, China has entered the global bond indices. I mean, China is a larger economy, yes, but geopolitically clearly an enemy of the West today. Not just that, China even issued symbolic in terms of just $5-10 billion dollar-euro bonds, so that Chinese corporates have a foreign currency denominated yield curve, and they were just very opportunistic in terms of lapping up money when interest rates are very low. I mean, we have kind of missed out the negative interest rate opportunity. It is completely silly of us to miss that. And remember, we are anyways doing that through multilateral agency or through friends like Japan when they give loans in yen
denominated yen for our bullet trains, etc. Those are foreign obligations we have in foreign currency terms. And then we go and say, look, somebody was so friendly to us, so low interest rates. Yes, they might have been. I'm not underplaying that. But we could have actually gotten that just off the market last couple of years. Not in terms of padding our reserves. Don't get me wrong. We should bought in rupees, not in foreign dollar terms, foreign dollar, euros, or yen. But it could have given an yield curve for our corporates to go out, just like China did. So I think there is an attitudinal issue here where we are extremely conservative. And what happens is RBI as an institution is very stodgy. And if a few former governors say something and it goes to the FM's office or the PM's office, understandably, nobody wants to put their neck on the line for something that a lot of serious people are calling risky, right? It just gets into the file of, okay, we'll think about this later. And I worry about the fact that we let go of some growth every year because of this narrative of a few upper middle class senior people who we falsely assume to be representative of all 60 plus people in India, most of whom are very poor, and say unko kya interest rate milega. Even there you can give direct subsidies actually, or direct concessions, as opposed to the 25-year-old man or woman who's trying to buy a house. And that is not how the narrative is formed. That's not how we position it or frame it. Because in India, let's be honest, along with cost of land, cost of skills, cost of input and intermediates, cost of capital is a real cost. It is much better compared to the past. I wouldn't lie right now because of this governor and just the general negative real rates because of the pandemic. But going forward, I don't think we have any clear framework for that. And the point is, you cannot be completely disconnected from the global cost of capital. If they are structurally going down, and that's a big debate by itself. But some people say, demographics are turning and the interest rates will rise. Some people are saying, no, look at Europe and Japan. The older you get, the lower real rates get. Some people say, well, if you have massive green investments, again, the interest rates will rise. Be as it may, it will be much lower than India's. What is unique about India and China they are, especially India, per capita poor countries, but much big, very unique situation. And what I call in the book A New Idea of India with Rajiv, it's like you go from the realm of Newtonian physics to relativity. Right? I mean, so Newtonian physics works at a particular scale, but when you have enough mass, you bend space-time around you, right? So certain rules which apply at this scale do not apply at that scale, or for that matter, do not apply at a quantum micro scale as well. So Singapore is a classic case of a very small economy where, because they're so small, their public sector can function as a private sector in terms of salaries and incentives and just general flexibility.
Agility.
Just agility. If you're India of 2010-15, you're in the middle, you should play by conventional orthodox rules. But when you start getting very large, yes, free market orthodoxy, good for most things, but you have to leverage dispassionately, unemotionally, your economic size, your monopsony, your power because you're no longer a price taker, you're a price maker, right? So which is why the industrial policy worked in case of cars, because last 20-30 years, we said, you build cars here, you serve the Indian market, otherwise you pay some extreme tariffs. And what happened was we ended up exporting cars, especially two-wheelers, but also four-wheeler ancillaries to the rest of the world. And we're doing very well there. We kind of let that go in for electronics in terms of cell phones and laptops, because we joined this WTO kind of TRIPS, intellectual property trade agreement 95-96. And we had less value add after that in our electronic sphere than we did before that. And we're only in the last 5 years correcting that because of this PLI schemes. And now we have massive Samsung cell phone factories in Noida and elsewhere. And initially they turn out to be assembling places. Then you go one step deeper and you do some more value add. Then you do some more value add. And it is just how it is, because what happens is if you just go completely free trade on this, and they already have invested in Vietnam, it does not make sense for them to now open a factory in India unless you make them open a factory in India, right? Yeah. Which a Bangladesh may not be able to do, because if they say open here or pay tariffs, and they'll say, okay, fine, the Bangladesh market is not big enough right now, we'll just pay the tariffs. But if India says that, and the Indian proposition, so you have to go far enough, but not too far. It's just bargaining. You say, India, if you want the access to the Indian market, you must manufacture here. And then they're like, you know what? Let's listen to these guys. Important thing is it should not devolve into cronyism. And so long as somebody manufactures in India, we should not discriminate between foreigners and Indians. And we did not in cars, for example, which is why our leading brands are foreign brands. Even Maruti Suzuki is technically Japanese, right? And same thing is happening with our cell phones. So it's not like we are saying the profit should remain in India or Indian listed entities. In the case of Maruti, it is. In the case of Hyundai, it is not. But at least create some jobs here, do some value add here, right? Put some facts on the ground. So I think that's what's very interesting to me.
Yeah. No, and I think, if you look at the digital economy, right? I mean, for long, India has been the DAO market, right? I mean, where you get users and not the ARPU market, where you get revenue actually. But then, I mean, if you look at some of the monetization experiments that have been happening over the last year or so, and I follow startups very closely, as you would know, right? The monetization experiments have been really promising. People have been getting 2 million plus paying subscribers for things like content, which you might consider an entirely discretionary spend, right? And
Or
so,
non-spend.
sorry?
Or not a spend at all.
Or not a spend at all, exactly, right? So the great thing about the Indian internet is that it's monetizable, right? I mean, with the UPI, you can buy and sell with all of these internet users. And from 600, we're going to go to 900 million internet users with more certainty by 2025 or so.
Yes.
Right. So I think that is a huge leverage. When you made this point, 2.5 years back, I think it was kind of ambitious. I thought of it as, something nice that we should definitely, use this as a leverage. But I think now more so it's become very real, I would say.
Yes, industrial trade policy is even more starkly visible, the entire concept, in the digital space and age. So, as you said, we are downstream, we were just users. So let's think about it this way. WhatsApp's biggest country is India, right? WhatsApp is owned by Facebook. We are letting Facebook have this market as part of a larger geopolitical understanding with the US, right? Okay, so for example, we export a lot of services there. And in this framework, our SaaS companies have started coming up and doing well, right? So you're incorporated, or if at least based out of India, and you're selling globally. It's a two-way product you're seeing right now. But that doesn't mean that some winner all kind of tech platforms go completely unregulated in India.
Yeah.
Look at South Korea, look at the European Union. For example, the Apple Store, Play Store platform, Google Play Store platform, the kind of percentage fees they cut.
Yeah.
These are all classic cases of antitrust enforcement. Another kind of area where I did a 180, going from a orthodox free market libertarian writing against antitrust 10, 12 years, 15 years ago, to now understanding that antitrust is just another instrument of geoeconomic state diplomacy, where because of the winner takes all, there is no logical reason for a particular platform to charge 40% of the fees just for on the platform.
Yeah.
It is just their market power. On that, against, you have state power, and it becomes a discussion. If you don't want to put it very antagonistically as a negotiation, it's just a discussion. And non-American, after all, South Koreans, Japanese, and the Europeans are also American friends. In fact, they're treaty allies. They're not even treaty allies. So I think as we go from 600 million to 900 million to a billion, and we go from 2G to 3G to 4G to 5G, and from dumb phones to smartphones, and then, AR, VR later on. And as you rightly said, and as we discussed multiple times before, this massive UPI kind of success, and it's no longer the transaction cost. You don't have to pay 100 rupees, the 20 rupees charge. Just 10 rupees is fine, completely painless. The entire Mufassal towns, large villages, all open up as a market for everything. I mean, Instagram is a massive, again, owned by Facebook, massive commerce platform today, right? So many housewives are selling kind of different kind of clothes or comic books, and it's just all, people. There is no reason for anybody to sit quote unquote empty at home. Like if you want to work, there is something you can do. Because the transaction costs have been dramatically lowered, right? I mean, it started with Uber and Ola and Swiggy and Zomato, because if you have some time, you can be a part-time delivery boy, and part-time you can do something else. If you run a full-time taxi, it's a massive issue, the medallion cost equivalent. But if you run an Uber, Ola, you can rent it from somebody, and you can go back to your village for 3 months, come back, drive for another 3 months. So all these kind of unique working schedules and downtimes, all of which can be in this gig economy, can incorporate that. And we are going further by just enabling, democratizing massive e-commerce through various platforms, right? This whole concept of Meesho and social commerce, things that you understand much better than me. So that these things are now being all possible, which is saying, okay, you have a skill set, we know how to monetize. If you do not want to monetize, it's a separate issue, but there is no more excuse for you not to be able to monetize. And it's important that our policymakers, there's talk of a G20 consensus on some digital taxes. We are in the early days, because what they would do transfer pricing. They would give all the royalties to the patent, which was in Amazon Ireland or Facebook Seychelles or wherever, Bermuda, right? And some tax heaven, and you could do billions of dollars of business here and not pay a penny in taxes, right? So that is changing, because there is real commerce happening here. You just can't read me the book and say you don't owe any taxes to the government. How do you indigenize that? How do you do that? How do you make your own national champions? So, for example, Facebook invested in Reliance. So then you say, okay, well, maybe if you rise, some of our companies rise as well. So we have to have it. It cannot be this kind of read the book, read the rules argument that Twitter says. You know what? It's a private corporation. I can delete whatever speech I want. But you are the de facto public sphere for a large thinking segment of the society, which has discretionary time and spend. If you say you're not responsible for the content, then you should also not censor. You should either be a completely throughput platform, but if you take the discretion of censoring, then whatever you do not censor becomes your responsibility. So we have to play hardball. I think we are playing hardball. We should not be surprised that if you push back on trade, for example, MasterCard and Visa were not happy with RuPay. They're still not happy with RuPay. RuPay has 65% of the volumes, maybe not in terms of value, but then of course all cards in general are getting slightly less competitive because of UPI and what will happen going forward and internationalizing that. So I often say on the international high table, either you are the diner or the dinner, right? So nobody likes, even friends don't like a new competitor. And India is becoming, and there will be a lot of lobbying, and there's a lot of pressure which happens for various lobbying and ideological reasons, which comes out in Washington Post op-eds and New York Times and The Economist, FT. They'll talk about data localization along with an article about look at how undemocratic India is. And you have to read between the lines that this is part of a good cop, bad cop policy. This is not to say that sincere people cannot have actual views disagreeing with you or me on India, but there is part of a sustained campaign. Always follow the money, that there is a good cop, bad cop policy going on. In India, industrial trade policy is never, ever smoothly accepted by other people, because within the free market realm, it is not zero sum. But within this policy realm, it tends to get zero sum at the top.
Yeah, absolutely. I mean, don't be surprised if you read about the balkanization of the internet and so on, right? Yeah, I mean, and platforms especially are such a low-hanging fruit.
Just one point I would like to add to the balkanization. See, the thing is, if others do it, it's balkanization. If you do it, it's a global liberal order. So if MasterCard and Visa remove themselves from Russia, that's just good corporate ethics. And now Russia is suddenly vulnerable on that particular front. I would not call it balkanization. I would not go, it's about creating redundancies in the global internet without going to the other extreme of crypto, right? So it's not every node is a full copy of everything that happened, but you need alternate power centers, because no one particular group of people, despite best intentions, can be a global Solomon, right? So that's all it is.
Right. So we've talked about plenty of the macro stuff, right? For someone who manages maybe a small business, let's say in Coimbatore or maybe up north, right? If he or she is kind of listening to all of this, what should they do, or what should their outlook be for the next year? How will all of this macro stuff impact their business very tangibly? And what should they plan for?
So I don't know about the next year, but the next few years, I think anybody who is in a position and has an inclination to take a risk, they should take a risk. They should be more entrepreneurial on the margin. I mean, assuming if they want to do that, because I really think that we are on the verge of massive growth story in India, because of a lot of short-term pain, long-term gain kind of situations that have been piling on. And we've discussed earlier also, like it's just spring just gets further and further pressed down. Fundamentals don't change, probably get better. And it's just a matter of release of that spring. So again, I don't blame if anybody's skeptical listening to that, because probably just you and me have had 2-3 such conversations. And they're like, when is those achhe din, right? I can understand if somebody is, skeptical, if not cynical. But, just follow the data. Just follow what the smart money. It's there. It's already, in relative terms, you're already close to becoming the third largest economy, the second and the largest population. We're already there. By next year, actually, we already are the largest democracy. So it has its own reflexivity, and it should not be underestimated, because what happens is when a country is elite, or at least large sections of the elite, you'll see 1 or 2 lakh people leaving Indian citizenship. That's really nothing. That's not a number to be bothered about. Of course, they're creme de la creme. I'm not saying any talent loss is a good thing. You should try to get talent back. I often say in our trade agreements, why do you call it a win if you get more work visas for us? I've never understood. I've discussed with some people in the know, and I just think it's one of those generational mindsets.
Archaic.
I don't think that should be a talking point. Yeah, it's very archaic. It's very anachronistic. I just think when by and large an elite of the country is invested in that country, they're not looking to jump ship. And in India, they are not. They're probably less than China. Again, 1 or 2 lakh people leaving in a year is not a big deal at all. Why? Because they think that, even if life in the short term, mid term might be better abroad, the opportunity here is so much more massive that some of the most talented people want to stay here. I mean, over and above patriotism, over and above family and culture and all that. Of course, these things go in, come and go in ebbs, right? But so there was a massive startup boom last year. This year, the funding is a bit of an issue, may remain for another 1 year, but then it will come back again. So the simple point is, nowhere else in the world you have such massive headroom to grow, such a massive population, young, starting point low in terms of per capita, basic governance, state capacity, industrial complexity being high, human capital being emphasized in terms of quantity, if not yet quality. You just don't have that combination anywhere. Like you have in Africa and the Middle East, you might have the demographics, but you don't have the state capacity. But you may not have the human capital trend, right? I mean, like, of course, in Saudi Arabia, many people might have very good advanced subsidized American degrees, but that entrepreneurial culture is not there because of the large scale scale is not there. So if you just scan across the world, there's nowhere else where you can get sustained near double-digit growth for an entire generation. And you can play this with the numbers. Dependency ratio 25 to 65 population. In India, it's still rising. In China, it has peaked. In other countries, it has peaked. The college enrollment ratios, again, an imperfect metric. You can look at literacy, imperfect, but near 100% for the young people. Again, quality is a different issue. But is it an improvement? Absolutely. Is there something that they can do plug and play into the global economy, which they could not even have thought about 10 years ago? They can. So then it just becomes impossible to bet against this kind of train. And I feel like, see, we are taking a judgment call beyond the here and now, beyond 1 or 2 years. And you have good reasoning, and you could be right, you could be wrong, I could be right, I could be wrong. It has to go beyond just the immediate data. You can extrapolate some of the data, but with the caveat that extrapolation has problems. And we are very much, as cliched as it is, we are at an inflection point. And which is why, as my third book is called Long India. I'm close to writing it, close to finishing it. And so I'm very, very excited about the growth trajectory of this country, because we are a very unique generation, very lucky and very privileged to be in our 30s, to be educated, to be able to kind of ride this massive wave that we did not do anything to create.
Yeah, absolutely. And since you mentioned startup funding, I have to bring this up. That so 2021 we saw about 40 billion or so, right, which is in a global perspective, which is really nothing, right? It's probably about 6 or 7% of the total VC funding for the second or third largest startup ecosystem in the world, right? Importantly, we have about 4 decades experience building IT, right? And building world-class products at that, I would say, right? And if you look at 2022 itself, where people are saying it's a funding winter, just in 2022, 20 VC funds have all raised a new fund, right? India-specific fund, I'm talking about. Yeah. Now, where is this money going to, go, right? I mean, it's not like VCs can sit out of
it's not a winter, it's more like an autumn.
Yeah, pretty much.
It's more like an autumn.
Yeah.
Maybe even a spring.
Yeah. So this money is going to get deployed over the next 2-3 years. I mean, they're not going to sit out of thing because of the financial cycles and so on. So all of this is very heady, optimistic stuff. You mentioned your new book, Long India, right? We'd love to get a sneak peek of what that will be about, and when can we expect it?
So definitely, hopefully within this year. And so the sneak peek is somewhat, based on the themes that we've discussed in this, exploring the demographic trends in much more depth. I'm exploring technological trends and the various macroeconomic, political, investing implications of that. You see, one thing that we've not discussed in this podcast, and that slightly more philosophical in nature, is, right, economy, as I said, it should be political economy. And the fact that India is today the world's largest nation state or political collective is not a coincidence. Like, you have to actually really go thousands of years behind and understand India's civilization and spiritual heritage. Right? It is difficult to get a lot of people to, right? It's not as some people smugly say, a creature of colonialism, right? Or post-colonialism. Because, for example, Pakistan and Bangladesh fell apart. India and Pakistan had to be partitioned. There were some issues, even the Sri Lanka and Nepal at some point. Of course, geographical contiguity and historical path dependence help, but there was something fundamental, right? I mean, the civilizational nature, the dharma, which allowed us to have diversity and unity. That, of course, if that makes the political unit, and as we discussed, the political unit size being larger is a big advantage in a volatile world for economic growth to happen, because it's no longer about just unilateral free trade, and therefore your domestic market size matters. In that sense, India's rise is not completely divorced from India's existence as a civilization. Again, a word that people may agree or disagree with, but India's fundamental syncretic nature is what allows us this political unit size. And people 30, 40 years from now will, obviously the world's largest political unit should be the world's largest economies, because historically that has been the case. It is when suddenly a new technology comes. I'm using technology in a very broad term. It could be colonialism, it could be in the formation of the nation state, it could be technology in the small t, industrial revolution, etc. And the so-called West raced ahead of the rest. But now any new technology is not happening in just one frontier nation. The US can still act as a proxy for the technological frontier to some extent, but the technological frontier actually is global, right? I mean, if you're doing R&D for the largest American multinationals in India, of course in America as well, India is layer 2, but all of this talent is being created in India. Not everybody's going to leave India. Many of them will start their own startups, right? So the technological frontier is not just one country, but it's global. A large part of the global, or at least an increasing part of the global, is in India. We have the political unit for historical civilizational reasons, and we have a starting at a much lower political unit. So it is, these things all interconnect in that sense, because that is what gives us the weightage to be very, very large. Because what happens is when you're very large, then you eventually get a hard currency, your currency becomes a reserve, you become a financial center, and a lot of the surplus, global surplus from the world over, but at least your region gets attracted to that place. And I'm a strong believer in India's democracy. I think we have a very good self-correcting mechanism. Just think 10 years back, right? The UPA 2012, people talking about massive corruption, the Anna Hazare kind of thing being in full flow. Everybody being so pessimistic about the India in 2013. We had the taper tantrum, the fragile five, the rupee suddenly depreciating much more than this year, and people were saying this is the end of the Indian economy. And again, all that is not happening because fundamentally we have a large young country, which unlike some other countries is still very much focused on education as a tool for coming up and everything that follows from it, right? Again, so much improvement is required on quality, on access, on everything. But this basic focus on this world, on bettering oneself and their family, on educating, on that basic pragmatic commercial mind. I think the raw material is ready geopolitically, socially, culturally, in terms of size. While we can discuss the graphs and numbers, and I will put all that in my book and all the various beautiful implications in terms of investing in finance. But I think we must not underestimate the basic building blocks, which we are very much inheriting and trying to just improve, but largely inheriting.
So when will the book be in the stores?
Let's see, hopefully this year, almost certainly this year. I'm actually in two minds. Balaji, who's a friend, just self-published his book. So our book, Westland, which got closed, A New Idea of India, which got closed, is now coming up in a different form. So they had to give back the intellectual property to the authors. It's being published by a very big publishing house. A New Idea of India is being republished. I just can't take the name of the publishing house because the contract will be signed in the next 2-3 days. But for this book, like Balaji, I'm thinking of self-publishing.
Yeah.
And the reason is just the delay. I talked to a lot of publishers, top publishers of India, and it'll take at least 6 months from submission of the book for it to see light of day. And I just think that's silly because a lot of this is very fast moving. And a lot of people have a taboo on self-publishing, saying, oh, you're not a successful author. But because I already have, for Indian English non-fiction standards, a relatively successful book with Rajiv, I don't have anything to prove on that score. I'm quite happy to self-publish. The only issue is Amazon does not do the print on demand in India. So the Kindle is very good. The print on demand happens globally. In India, it's just not cost competitive as of now. So I might have to get published like a friend Ashish did for one of his earlier books. So I'm thinking about that. But in terms of the content and writing of the book, I think it should be done in a month or two. It's more than half written. It's just that as we speak, so much exciting stuff is happening in the global economy that it's really exciting to follow that and think about that, invest based on that, as opposed to just writing about it. The long-term trends don't change, but we are living in very exciting. Anybody who follows global macro right now is a very exciting time. So hopefully this year, if I self-publish. If I don't self-publish, then the writing will still get done this year, but maybe early next year. The book.
Yeah, that's amazing. I think you should probably do what Balaji is planning to do, right? Call it a book app basically, and keep updating sections of the chapters as and when.
Something to think about, right? Like why should a book be like
static?
Whatever he says it's a book, right? And it can be dynamic. I can have an app on that as well. So it's good to do the conventional thing initially, which my first book, Derivatives, with Anant and Dr. Somanathan, Dr. Nageshwaran and Dr. Somanathan, was by Cambridge University Press. Second book with Rajiv was with Westland, and now a new publisher, a very prominent publisher, will announce soon. But this book I want to do slightly more Bangalore/Silicon Valley style in terms of the publicity publishing /print.
Well, you've moved on a relative basis. You moved closer to Bangalore, so
I almost came to the city. But anyway, that's an offline discussion.
Hey Harsh, this is as usual a fascinating conversation. I enjoy talking to you because I think you're one of those people who have real skin in the game, and also unafraid to have certain bold views. You put yourself out there, and also so eloquent and articulate about all of these views, which makes it all a rare combination, really, right? So I'm actually long India for people like you, right, who can articulate these kind of views and
vice versa, Roshan. I don't know how you do a full-time job and this podcast together and be really good on scheme of fitness. So
right.
Really
having no social life helps, but
That's my
Yeah.
secret as well.
Yeah. Thank you so much, Harsh. This was amazing. Yeah. Thank you so much.
Thanks, Roshan.
Thank you for tuning in to this episode of the Bharat Varta podcast. If you want to see more content like this, then don't forget to subscribe to our channel. We started Bharat Varta to facilitate long form discussions on politics, policy, and culture. We don't necessarily endorse anything that was said in this episode. If you wish to offer us feedback, do reach out to us on social media. We are at Bharat Varta on Facebook, Twitter, and Instagram. You could also get in touch with us on our website www.bharatvarta.in. The links are in the description below. Until next time, stay safe, take care, and Jai Hind.